working on is international tax and permanent establishment, and then something on the foreign tax credit. And as the name may sound, international tax, it's a very interesting topic. But first of all, what do we understand by international tax? In the past, when the businesses were required to have a brick and mortar kind of a model, meaning you necessarily have to set up a business presence in the other country. Now, with the digital phase, you do not need a physical form of a presence in another country. I mean, you have seen probably, Amazons of the world, they do not need to set up any physical presence in another country, and they can still, run their business sitting into another country. And therefore, the international tax and the allocation of taxing right among the countries becomes very important. So when we say international tax, it's basically it is basically the set of rules which will define as to how the cross-border activities of a business will be taxed. And that is important because unless you allocate the taxing rights between the countries where the cross-border trade is happening, it will result into a situation where one country is not taxing or one country is not taking their fair share of revenues on the taxable profits which are being earned in that source state. And therefore it is very important. So UAE, and how does that happen? So you will have the provisions which are pertaining to taxation of a non-resident in a particular country, and then you will have the double tax treaties which will define as to how the allocation of taxing rights will be done between those countries. So similarly, I mean, when you talk about the UAE taxation law, in the federal decree number 47, they have defined as to how a non-resident will be taxed. So let me Article 11, I think it talks about that corporate tax shall be imposed on a non-resident if it has a permanent establishment in the UAE, if it derives any state-sourced income, or if it has a nexus in the UAE. These are the three categories where the non-resident can be taxed in the UAE. In addition, we will also talk about when a foreign company can be taxed in the UAE if it is having a place of effective management in the UAE. And this place of effective management we commonly refer to as POEM, but this is not a music to ears for various companies. So given the fact that permanent establishment has been covered by Manoj in a great detail, I will just talk about what is the relevance for nexus and what is the state-sourced income which can be taxed for a non-resident in the UAE. So nexus has been defined in the cabinet decision number 56, and it says that if there is any immovable property which a non-resident has in the UAE, that will create a nexus, and any income which is being derived from that immovable property, that will become subjected to tax in the UAE. The term immovable property and what is income from immovable property, that has been very widely defined. So it will pretty much cover all types of income which can be derived from an immovable property, whether it is by way of a letting, subletting, or anything to do with the sale of that immovable property. But I think what is relevant to note over here is that when we are talking about this nexus, this is only relevant for a juridical person or a juridical person having an immovable property in the UAE. It doesn't apply to a natural person. The natural person's taxability when it comes to having an immovable property in the UAE, that will get determined by the cabinet decision number 49, and if that income is not carried out through a commercial license or is not required to be carried out through a commercial license, then that income will not be subjected to tax. So this is only for a juridical person. So essentially, if there is a foreign company having an immovable property in the UAE and it derives income by way of a letting, subletting, or anything which is in the nature of a sale of that property, that income will be subjected to corporate tax in the UAE. Then comes the second category, which is the state-sourced income. And again, state-sourced income has also been widely defined to cover pretty much everything in its encompass. So if you see, income from sale of goods is covered as the state sourced income. Income from provision of services are covered as state sourced income. Income which are derived by a contract which is performed partly or wholly in the UAE, that is considered as a state sourced income. Income from movable or immovable property, anything which is in the nature of disposal of shares of a UAE company, anything which is for right to use an intellectual property, which is like a royalty income. And then, if there is any interest which is being paid by a resident person, that is also a state sourced income. Typically what will happen is that if there are any of these examples of state sourced income, the income will get taxed by way of a withholding tax in the UAE. Now, currently the withholding tax rate has been set at 0, and therefore, even if there is a non-resident who has been earning any income which is a state source income, it is not getting taxed effectively. But the moment this 0% withholding tax rate is increased to a rate which is higher than 0%, these provisions will become relevant, and a non-resident will be subjected to tax by way of a withholding tax in the UAE. Coming to the permanent establishment, I think the fixed price PE, the agency PE, the construction PE, all these things have already been covered, so I'm not going to spend too much time on it. But maybe one more aspect which is relevant is the service PE, and that is something which I will want to talk about. So if you see, how does a service PE come into existence? Typically, if there is a foreign company, and if that foreign company is having its presence in another country by way of its personnel or through by way of its employees or through other personnel, that can result into a service PE. Now we have seen, provisions in India or provisions in KSA where a single day presence of an employee can also trigger a service permanent establishment. Luckily, UAE is much more lenient, and UAE is saying that, look, if there is a person who is present in the UAE, but if that person is not engaged into carrying out any core income generating activity, or if that person has, and that is not resulting into any revenue for the non-resident, it will not give rise to a permanent establishment. Similarly, they also came up with a cabinet decision or a ministerial decision number 83, which also explains that, look, there could be situations where a person came to the UAE and remained in the UAE, which were situations of public nature or private nature. Even in such situations, the extended presence of that person will not result into a service permanent establishment. Now, these situations could be private nature. So, for example, the person has fallen sick after he came to the UAE and therefore he is not able to travel. Or these situations could be situations of public nature. For example, what we saw in Corona, people came to the UAE and then they were stuck. They were not able to go back for a long period of time. So such situations have been covered to say that if the person remained, even if there is an extended presence, that should not result into a permanent establishment, as long as the subsequent events prove the point that, look, the intention of that person was not to remain in the UAE, and after those situations ended, the person was able to go back outside of the UAE. These are some examples of permanent establishment. I think the consequences, what happens if the permanent establishment gets triggered, this has been covered by Manoj ji. So I'll talk about maybe the place of effective management. So if you see place of effective management regulations, it essentially says that if there is a foreign company which is effectively controlled and managed from the UAE, then it will become a resident, it will be considered as a resident person, and then all the provisions which are applicable to a resident company will become applicable to that foreign company as well. So what does it mean? It essentially would mean that the foreign company will be regarded as a tax resident, and any income which it is earning will be subjected to corporate tax in the UAE. And how do you determine that this company is being effectively controlled and managed in the UAE? And I think there is not too much clarity which has been given, but internationally, if you see, there are OECD guidelines which talk about this concept, and the crux of those guidelines is that if a company, if there are strategic and commercial decisions which are necessary for the conduct of a company's business is being made, let's say in the UAE, then that foreign company will be considered as a resident in the UAE. But it's a very fact-specific exercise. So, in a situation where the foreign company becomes a resident, it will need to pay taxes, it will need to register for corporate tax purposes, and simultaneously, if there is any taxes which are being paid in an overseas jurisdiction, they will be available as a credit, because a normal company would have got that credit anyway. So, if you see Ministry of Finance FAQ number 20 and 45, they talk about the fact that all the facts and circumstances must be considered in determining where a company is effectively managed and controlled, but a relevant indicator may include the place where the strategic decisions affecting the business are made. And then they also say that this will need to be assessed on a case-by-case basis, and one may have to look at the location where the key decision makers, such as the directors, make the strategic decisions affecting the juridical person. Now, in the UAE, when we are examining situations, we come across situations like this, that there is owner of the business who is there in the UAE, and then strategic decisions for a business which is outside of UAE is being made by the owner sitting in the UAE. Similarly, there could be, a UAE headquartered business. It could have an intermediate holding company, let's say in Netherlands or in any other low-taxed jurisdiction like BVI, Guernsey, or Cayman Island. But the management, continues to remain in the UAE, and that is where all the strategic and commercial decisions are made. Now, all these structures are at a risk because of the place of effective management regulations. Now, what do you do if you have this risk? Obviously, first is to assess whether we have a risk. Second, whether there are, any safeguards, which can be put in place. So, for example, the board meetings can be held in that particular location. The board minutes can be maintained in that location. The books of accounts can be maintained in that location. If some of these things are taken care of, then there is a possibility to argue that the effective management of that company is located outside of the UAE. Also, it is going to happen that for certain strategic or commercial decisions, the subsidiary company will come back to its head office and they will ask for the decisions. Now, can you bifurcate the functions in the nature that what are the functions which are in the nature of a shareholder function, or what are the decisions which are in the nature of a commercial or a strategic decision making related functions. Now, things which are in the nature of a shareholder function, obviously those will need to remain at the shareholder level, but things which can be done at a managerial level by way of a management service agreement. So one can look at entering into a management service agreement with the subsidiary company, saying that even if there are certain decisions or even if there are certain recommendations which are being given by the head office, those are in the capacity as a service provider, and then we at the local level have the ultimate decision making authority to go ahead with those decisions, to implement those decisions. If some of these aspects are taken care of, then probably the businesses will be at a better position to defend the place of effective management risk. Now, obviously you need to put in that, and if some of these things cannot be done, then one can also look at that, does it result into any sort of tax outgo, or is it just an administrative burden which we will be embarking on? So, take an example, let's say there is a Netherlands entity and that Netherlands entity gets taxed in the UAE because of the place of effective management regulations. But Netherlands has already got a rate which is more than 9%, and if you get a credit, then effectively that will not result into any additional tax outgo. But it increases your administrative burden because you need to register, you need to file a return, you need to take a credit, and all those things will come into picture. So, whether we necessarily need that, that entity, or can we re-domicile that entity back into the UAE, and therefore we just have to do one compliance. So, some of these things will need to be looked at, and of course it will depend upon case-to-case basis as to what is the most appropriate most appropriate solution to take it. I think foreign tax credit, so just to go back, we covered the nexus, we covered the state sourced income, we also covered in a slight detail the permanent establishment, and then of course the POEM. Now, what is also relevant is to look at that, how does the foreign tax credit will work. And I know that in the first session which we had, which was a panel discussion, some concepts of foreign tax credit have already been discussed. So I will just explain the foreign tax credit mechanism by way of an example. So if you see this example, and I know that the basic principle is that while if there is any income which is getting doubly taxed, that income, in such cases, you can take the foreign tax credit to the extent of the UAE tax on that relevant income. Now, let's understand this by way of an example. So you have a scenario 1, wherein you have a gross revenue of 1 million, you are earning an interest income in an overseas jurisdiction, that interest income has been subjected to a withholding tax, and how do you take a credit for that? And in the second scenario, you have a dividend income where that dividend income is eligible for participation exemption. Can you take a credit against that? So obviously in the second scenario where you have a dividend income which is subjected to the participation exemption, then it is not getting taxed in the UAE again, and therefore you will not be able to get a credit, and that whatever withholding tax which is happening outside of the UAE, that will become a cost of doing that transaction. In the first scenario, which is the interest income which has been earned, that which has been subjected to the withholding tax, you should be able to take a credit to the extent of UAE tax on that relevant income. So in this scenario, if 200,000 is the income, and on that the UAE tax is 9%, so then one will be able to take the credit to the extent of 18,000, but not the entire 20,000, and this 2,000 will be a credit which will be lost. Now, obviously in this example, it's a simplistic example, and I have assumed that there is no corresponding cost which has been incurred in earning this interest income. Take a scenario where some services are being rendered, and in that service situation you will have a withholding which is happening at a gross basis, but the income is not, that entire gross revenue is not income. So in such scenario, one will have to find out as to what is the income component in that transaction, what is the relevant UAE tax on that income component, and only to that extent the withholding tax credit will be available. So what are the key takeaways for us? Obviously, businesses would need to carefully assess the POEM as well as the PU risk. And one will need to look at the domestic provisions as well as the tax treaty provisions, because in certain cases the tax treaty provisions could be more beneficial, and in those cases obviously one should look at taking advantage of the tax treaty provisions, because the UAE law specifically says that if the tax treaty provisions are more beneficial, then those will prevail over the domestic law. If there is a POEM or a PE which is coming into existence, then do you have any actions by which it can be mitigated? If it cannot be mitigated, then obviously one would need to register, need to comply, need to pay taxes, take foreign tax credit. All those items will become extremely relevant. And then of course, if the tax treaty benefit which I already talked about, the foreign tax credit will be available, and yeah, and also there is a, if there is a withholding tax credit which is, if it exceeds the overall tax liability, then that withholding tax will be available as a refund. Of course, in today's scenario, it is not applicable because there is no withholding tax on the, there is no withholding tax, or the withholding tax is set at the rate of 0%. So these are the key takeaways. it's been, I've just tried to take some very, very basic, principles regarding the international taxation. Hope, it was able to add some value, but happy to, take any questions, happy to answer anything either now or, during the break outside. Thank you so much. Anybody? We have some time, so happy to take a question. Yes.
So you mentioned the foreign tax credits. Do you think that the UAE may take it as source by source, or do you think it will just be on a basket basis? What I mean is, if I have income, if I have income that's, say, from two jurisdictions, you mentioned Netherlands as one, perhaps, and we take, in my primary example, Hong Kong, which has a 17%, US, which has a 30%. So obviously both are above the 9%, but could I take income from both jurisdictions as a single income in the UAE and look at the 9%, or do you think I need to differentiate it?
Well, I think one will need to go on the basis of source as to where the income is coming from. But if in all the cases, if the income is coming from a source which is at a rate, which is more than 9%, then it is likely that it will result into an indifferent kind of a situation, whether you go on a each country basis or whether you go on a basket kind of a basis. But I would assume that when we are looking at the foreign tax credit, one will need to look at what is the income which is coming from a particular jurisdiction, what is the tax rate which it has suffered, and whether I should be able to get a full credit of that tax which it has suffered. In a basket kind of a situation, if we start basketing it, it could result into an overutilization of credit, which may not be the intention of the law.
Okay, thank you.
Right. I have, just in case, you talked about effective management. So in case if there's a board meeting and where the decisions are taken by the board members who are not resident of UAE, but the board meeting is, let's say, online. In that case, is there any guidance on where the effective management is considered?
Unfortunately, there is no specific guidance which is available as to if the board meeting is, taking place virtually, how will you decide? I think one of the criteria to look at it could be that, look, even if the board meeting is happening virtually, what is the composition of the board of directors, and whether the board of directors are coming from only UAE. In that case, probably it's a difficult position to take that all the UAE directors are meeting in the UAE virtually and then they are taking a decision, which means the board meeting is being conducted in the UAE. But let's say the composition of the board of directors is coming from different jurisdictions, and UAE is also a part of, that composition of board of directors, then, one could still try and take an argument that, look, it's not that the board meeting has not been held in the UAE, it has been held virtually, but UAE also, UAE's director also just contributed to that board of directors meeting.
So the other question I have is also on the position of a general manager, because many companies here, the LLC companies have a general manager, and a general manager may be a resident, may not be a resident of the company. Is there any guidance on how does that affect? Because effectively, as per the law, the general manager is the decision maker, at least in UAE, for a LLC company. Is there any guidance on that?
So if your question is that if it is a UAE company and if that UAE company is having a general manager, then the UAE company is anyway, a tax resident by way of its being incorporated in the UAE. And therefore, anyway, the worldwide income is taxable, irrespective of the fact. So this place of effective management regulation is relevant only when there is a foreign company which is being managed from people sitting in the UAE. If I understood your question right, if it is a UAE company having a manager, then anyway it is taxable because of it being incorporated in the UAE.
Hi Dinesh, thank you for the lovely presentation. Here.
Yes, thank you.
So you spoke about in the context of service fee, a service fee would get triggered if the person on ground is doing a core income generating activity. Now, how do you apply this test to a structure where you have a rep office here and all the employees of rep office is basically doing nothing but promoting the product of the overseas company, right? In that situation, if the overseas company also happens to be in a distribution setup, do you consider marketing and the promotion activities which are done by the rep office employees as a core income generating activity? If yes, what happens to the income of the non-resident from the UAE region?
Okay. I think seems to be a very, very fact-specific question, and I can take it offline, but my 2 bits on this question would be that if the rep office people are only acting as a communication channel between the head office and the customer, which is over here, there is a possibility to argue that it should not result into a permanent establishment, because they are not the decision makers. They are only acting as a communication channel, and the final decision to sell the product, ship the product, all those decisions are made by the trading entity or the distributing entity. But if the employees of that rep office are doing much more, they are concluding the contracts, they are effectively doing the negotiation which are leading to the conclusion of contracts, and their head office is just following what the rep office is telling them to do in terms of supply of those products, it is likely that it will result into a permanent establishment. But having said that, I think we can take this question offline, because it seems to be very, very fact-specific question. Yes, Rishi.
First of all, thank you, Dinesh. Great presentation. I just have a question on POEM risk. And me being a transfer pricing advisor, it's very hard for me to digest this technical position. Because if I speak about practicality, more than 90% of the UAE businesses are family owned and managed centrally from here, like a control tower, as I was saying in my presentation. Now, if I have an overseas entity which is paying its fair share of taxes, being managed by someone, yes, under the direction and supervision of the UAE, which is most of the time a centralized business operating model, I understand that POEM might be a risk, theoretically, but what do you think, what is the probability of this risk being materialized in the UAE? And do you think that the UAE tax authorities are aggressive enough that they would start taxing all the overseas jurisdictions here, and there would be a lot of litigation and double taxation? And if it happens, then it's quite a painful process to just claim back the credits, as I wanted to know.
Great question, Rishi. So you are absolutely right. I mean, if you really look at the UAE taxation, the principles are, there are best practices which they have adopted from some of the countries, where the regulations have evolved. And I think it will take some time for, for the UAE corporate tax law to evolve, and we will have to see how the behavior of the tax authorities is going to be. My sense would be, and this is something which, which is my personal view, please do not consider this as a Deloitte view. My sense would be that UAE tax authority should first be concerned about how they are taxing the resident entities which are incorporated in the UAE. They would rather not be looking at those companies which are incorporated outside and being managed from the UAE. One of the additional consideration which could be relevant for them is that if it is a foreign company, and if that foreign company is paying taxes in that jurisdiction, even if they bring that company within the purview of taxation in the UAE because of the POEM regulations, it may not result into any additional tax inflow, because they will be able to take because the company will be able to take the credit. It can only increase litigation, and if there could be, certain administrative burden which it will increase on the companies to follow, the filing requirements, etc., etc. So my sense would be that the tax authorities would be looking at not those companies which are the operating companies outside of the UAE, but if there are companies which are purely holding companies and which does not really have any substance, or if they are there in a low taxed kind of a jurisdiction or a tax haven, those companies will probably at a higher risk as compared to the operating companies. Rishi, does that answer your question?
Thank you very much, Dinesh.